Hello and welcome. Today we're working on what is internal control in accounting. So if you're new to the channel, my name's Jeff from Finally Learn, where I help you finally learn financial literacy. We're working on financial accounting right now. So if this is helpful for you, please like, please comment, ask your questions below, and please subscribe. So here's where we're located. We're doing the financial accounting chapters right now. So cash and internal control is chapter 7. So I've got articles and videos and playlists. So that's going to be helpful if you're trying to learn accounting. So let's talk about internal control. Internal control is the idea where you're trying to safeguard assets and your financial records and financial reporting and things like that. So here are some lists, and I'm trying to come up with some mnemonic devices for you that's going to be helpful. So there's 4 objectives of internal control. And it's to safeguard the assets. You want to protect your assets from fraud or theft or whatever. You want to have compliance with any laws or policies or regulations. You want to have operational efficiency, so you want to do things in an efficient way. And then we're concerned about the reliability of our financial reporting. So I've put together an acronym just called SCOR. So safeguarding, S, compliance is the C, O, operational, and then R, reliability. Now, there's such a thing as a fraud triangle. When you're thinking about internal control, you need to be a pro at this. See what I did? So there's 3 things that are involved in why does somebody commit fraud? Well, there has to be some kind of pressure. Maybe they're in debt. Maybe there's gambling. Maybe there's some kind of need to live beyond your means or a desire to have more money. And then there's a rationalization. Well, they don't appreciate me, I don't get paid enough, or they won't mind if I borrow this and return it. I'll return it before they miss it. And then there has to be an opportunity. So to be a pro, have pressure, rationalization, and opportunity. So you want to make sure that these are all minimized. And so one of the things you would do at work, you make sure people do not have opportunity. You don't leave cash laying around. You say, oh, by the way, there's $15,000 in the drawer in the office. Nobody steal it. Well, that gives people an opportunity, right? You wouldn't do that. So you make sure you think about, with a critical eye, what is a possibility. So the fraud triangle, pro, pressure, rationalization, opportunity. Now there's 5 components of an internal control system. So they might say system of internal control or whatever. And so I've kind of rearranged them slightly, and I'm going to use Eric M. So control environment, take the E, so environment. Risk assessment. Information and communication is the I. Control activities is the C. And monitoring is the M. So control environment. It's the idea of what is the tone at the top. What is our organization's values and integrity? Do we hire people with competence that have integrity and so on? That's very important. The risk assessment. What are our potential risks? So you need to be thinking about, hey, there's a chance where if we don't have good internal controls, then things get stolen or damaged, or there's theft or fraud or whatever. The next one is information and communication. So what kind of communication are we making with our employees and staff and colleagues? What kind of training, what kind of written policies, and what kind of emails go out talking about information and communicating the internal control. The next is the control activities. These are all the policies and procedures you put in place to make sure that you're trying to have a good system of internal control. And then monitoring is you're going to review it for effectiveness. It could be continually monitoring. It could be a periodic monitoring. Every month we go and review, are the things we're doing effective? Now, you're never going to have complete assurance. So this is the idea. Auditing now a lot of times is called assurance. So you audit a financial records of a company and they talk about assurance. Well, you're never going to have complete assurance. You're not going to get rid of every risk, but you want to have reasonable assurance. Now, for example, if you drive a car, you want to make sure you have a good quality tires on your car, right? And so you might not have to go out every day and buy brand new tires, but you want to make sure your tires are a year or two old, not 15 years old, and you think, well, I don't know, I hope I can make it. That's going to be too risky for you. And say, I'm going to drive down the interstate at a very high speed. Well, that's very risky. So you can never have complete zero risk or complete assurance, but you want to have minimized risk or a reasonable assurance. Now let's talk about Sarbanes-Oxley Acts. We're going to go over to my website. So here, finallylearn.com, I've got cash and internal control. So let's go down to talk about Sarbanes-Oxley. That's more than I wanted to put on this little spreadsheet here. So Sarbanes-Oxley, or SOX, is a famous act that was in response to famous corporate scandals like Enron and WorldCom. It came around in 2002. So if you ever hear about SOX, if you take an accounting class, they talk about SOX. You take an auditing class, then you're talking about SOX all the way through. So let's talk about briefly what are some of the issues that they brought up in the SOX, or the Sarbanes-Oxley. Well, they're making sure that there's corporate responsibility for financial reports. Executives must take individual responsibility. They sign off. We know we're personally responsible. If I'm the CFO, the president of the company, we are responsible for the financial reports. So you have increased independence of external auditors. You have to have an audit firm if you're a publicly traded company, and so therefore increased independence, trying to prevent conflicts of interest. The SOX Acts created a Public Company Accounting Oversight Board, and I think some people call it peekaboo, which is kind of funny. And so there is now an oversight board to oversee public audits. And so that is in effect. And so then there's some ways for companies and for auditors to reach out and say, hey, what is the standard? Here's what we're finding, or I can be a whistleblower or whatever. Enhanced financial disclosures, they required more financial transparency. There's more internal control requirements in Section 404 of SOX. It requires companies to annually assess and report. And so the one problem is this is increasing the cost of compliance. For a big company, maybe not a problem, but for medium or smaller companies, this can be a bigger cost. Whistleblower protection. So if someone comes forward and says, hey, there's fraud going on, then we try to offer protection for corporate whistleblowers in the SOX Acts. Increased penalties for corporate fraud and enhanced SEC oversight is basically part of the ideas of SOX. Now, if you have a professor that teaches auditing or really likes internal control, then these things are things that are important that you need to make sure you understand. If you're taking auditing, you know you need to know the SOX. All right, so here we've done several things. Let me talk about one more thing. There is such a thing as the COSO, the Committee of Sponsoring Organizations, COSO of the Treadaway Commission. Now, this organization develops internal control integrated framework. So if we click on through, COSO says, hey, here's our integrated framework, and it gives guidance on what should we look at for internal control. All right, so this is helpful for you, hopefully, with internal control. I've got lots of videos on cash and internal control, so see you in the next video. Thanks for watching.